Welcome to this audio flip chart on fundamental value risk. My name is Manfred Frühwirth. I'm professor of finance at WU Wien, which is Vienna University of Economics and Business. The purpose of this audio flip chart is to show you one important reason why arbitrage by smart investors does not automatically make the security prices adjust to the fundamental values, as argued by neoclassical finance. Behavioral finance provides several explanations for this. These explanations are included under the umbrella term limits to arbitrage. One very essential mechanism is fundamental value risk. This audio flip chart focuses on the fundamental value risk in a situation of undervaluation. I want to show this at the example of a stock. For a stock, as for every security, conceptually, we have to distinguish between the price and the fundamental value. The price is what you can observe at stock exchange. This is the amount that you have to pay if you are buying the security and the amount that you get if you are selling the security. The fundamental value, however, is the true value of the stock. It is also called the fair value or intrinsic value. You can determine the fundamental value by performing a sound valuation of the stock, for instance by discounted cash flow valuation or by using the dividend discount model. On this flip chart we have on the horizontal axis time. So as we are going to the right, time elapses, and on the vertical axis we have the price and the fundamental value. Now let us imagine that we are in a situation of undervaluation. Therefore, the price, symbolized by P, is smaller than the fundamental value, symbolized by the black FV. According to neoclassical finance, the consequence would be that smart investors observe this undervaluation, and as a result, they buy the undervalued stock. As sooner or later, and neoclassical finance thinks rather sooner than later, the price will have to converge to the fundamental value. The arbitrageur only has to wait until the price has increased towards the fundamental value, and then can realize an arbitrage profit by selling the stock. On this flip chart, we assume that the price hits the fundamental value at time t. So ideally, the arbitrageur buys the stock at time 0 at the original price p, waits until time t, and then sells the stock at the price fv. The arbitrage profit is the difference between the future price, which is the fundamental value, and the original price P. This is shown on the flip chart as profit. This is the neoclassical finance argumentation. In contrast to neoclassical finance, behavioral finance argues, and practical experience shows, that sometimes it may take quite some time until the price has converged to the fundamental value. Therefore, the arbitrageur has to wait until he can cash in his arbitrage profit. The problem is that during that time, many things may happen. For instance, it may happen that, independent of the arbitrage strategy, the fundamental value suddenly goes down to the level of the red FV. Potential reasons of this are supply and demand shocks due to a pandemic crisis, or alternatively, company-specific problems like compliance problems or technical problems. These problems cause a decline in future free cash flows and dividends, and therefore reduce the fundamental value. In that case, of course, by time t, the price will rather converge to the new fundamental value in red and not to the old fundamental value in black. As a result, at time t, the arbitrageur has to sell the stock at a price that is lower than the price that he has originally paid. And this, of course, creates a loss for him. This loss is shown on the flip chart as loss in red. Of course, you could easily draw a similar flip chart for the case of overvaluation. The arbitrageur would sell the stock short at time 0, wait for the price to decline towards the fundamental value, and then buy back the stock at the lower price. Fundamental value risk means that the fundamental value may increase, for instance, due to unexpected successful projects, even before the arbitrage strategy is closed. Looking into finance history, you can see that such things happened several times and led to spectacular problems, near bankruptcies, and even bankruptcies. Summing up, the learning outcome of this audio flip chart is: as a smart investor, even if you make everything correctly and perform an arbitrage strategy as described in standard finance textbooks, you may end up losing money simply because the market takes too long to level out the mispricing, and during that time the fundamental value follows and passes the market price instead of the market price following the fundamental value. In turn, this may lead to the situation that smart investors do not even dare to perform arbitrage strategies, even if the price deviates from the fundamental value. This has an important implication, namely that in contrast to the neoclassical finance framework, we can no longer rely on the fact that smart arbitrageurs make the security prices converge to the fundamental values quickly, and that on the capital market, the prices reflect the true values. I hope you enjoyed this audio flip chart. Thank you for watching.